Okay. So, Kat, you say that you want to know whether we are going to impair land, isn't it?
Yes, please.
Okay, I'm saying that if there is a soil erosion, what happens to the land? Kati, answer my question. If there is a soil erosion, what happens to the land?
I can't hear.
I'm saying that if there's a soil erosion, what happens to the land? Kati, can you not hear me? Kati, can you not hear me? Okay. Since you are not here, let's continue moving. So this one will be shared among equipment, land, and what? Building. So what is the total? What is their total value?
I was saying it will lose its value.
And so we assume that there is a soil erosion on the cash generating unit. So you depreciate you impair all the non-current assets in the group. All right.
Okay.
So that would be, what is their value? 10, 50, and 80. What would be the total value?
130.
Someone is saying it is soil but no land. The soil is on what? Yeah, so many. Now, this one, 10 plus 50 plus 80 is what? The net asset will not take this one because they say that is the true representation of their fair value. So this will be 10 over the total. This will be shared among only 3 assets. 10 over 80 times the impairment loss. What is the remaining impairment loss? It was 70. Technology took 5. And good also took 20. So what will be the remaining one? 70 minus 25. 45. Okay. So what are we getting?
Linus, can you go over that place again?
I'm saying that the remaining portion of the impairment loss was 70 million, isn't it? The impairment loss was 70 million. Are you there? The person
I'm here.
Okay.
I'm here.
Technology took 5, isn't it?
Sure.
Goodwill took 5. So that it means
20.
that 70, there will be portion remaining again. That will be 45.
45,
This 45 will be shared among the other non-current, the remaining non-current assets, which is equipment, land, and building. If the question should say that the net asset has also reduced beyond their carrying value, then it means that the difference between them will also be seen as impairment. But the question was saying that the other net asset, the value over there is the true representation of their net realizable value. It means that is the value that we can get from it. There is no reduction. There is no increase. Are you okay? All right.
Yeah,
At the date of the impairment test, at the date of the impairment test, the question can also go ahead and give you equipment figure of 20 million. That this is now the value of the equipment. What was the value of the equipment first? It was 10 million, isn't it? They are not giving you at the date of impairment that is 20 million. What they are trying to tell you is that the equipment has not impaired. That's what they are telling you. The equipment is now 20 million. It was 10 million first. It means that the equipment has not impaired. So don't share the impairment loss to the equipment. So sometimes the question can give you the cash generating unit and they will still give you new values. They can also give you the equipment to be 8 million. It means that the equipment has impaired by only 2 million. So you share only 2 million to the equipment. It was 10, now 8. It means that it has impaired by 2. But whenever they give you a value which is higher than the one that you have originally, it means that particular asset has not impaired. So don't share the impairment to that particular asset. But since they have not given us anything like that, we assume that the equipment, land, and building, they have all impaired. Right? So let's share that. It will be 10 over the 80 times 45. What will be the
Linus?
Yeah.
Linus?
Yeah.
Please, why 8 but not 90?
Is it 90?
Yeah, 10 plus 50 plus 30. Is that not so?
Okay. It's 90. All right. Sorry.
Okay. Thank you.
It's 90.
Lionel,
Yes.
what about the net asset?
Kati, where were you?
My line is going on. I don't know whether it's from your end.
Why should it be from my end and I will still be talking here? Let's come here. Following its complete failure, other net assets include inventory, receivables, and payable. It is considered that the carrying value of the other net asset is a reasonable representation of its net realizable value. It means that the value over there is the same as the value that we are going to get from it. There is no addition, there is no reduction. So the value
Okay,
over there is
thank-
the same as the value that we are going to get, and that is all.
Please, thank you.
All right. So 10 over 90. Hello?
Yeah.
All right. So what will be the answer? 10 over 90 times 45. How much are we getting for equipment?
5.
5. Okay. Then building. Building is the next one on land.
It's land.
Okay.
5.
Land will be, what will be their figure?
50 over 90 times 45.
Okay. 50 over 90 times 45. How much are we getting?
25.
25. Okay. So you don't even have to calculate the one again. Just put 15 here for the last one because you are sharing 45. Okay.
Okay.
Building. Okay. So this is the impairment loss now. All right. So after the impairment, you now come and show the new carrying value after the impairment test. So I'll do it over here because I still have this one. Goodwill will be 0, isn't it? After the impairment, there won't be any goodwill again. Goodwill will be 0. Am I
Yes.
correct?
Yes.
Technology will be what?
0.
Okay. Equipment will now be 5. The impairment loss was 5. So 10 minus 5. Am I correct?
Okay.
Okay. Land will now be 35 because the impairment was 15. So
No, 20.
15
25. Land should be 25.
Okay. So the impairment was 25.
Yes,
Okay.
please.
Bidding will be what? 15.
15.
Okay. And the net asset will still be the net asset. At the end of the day, if you add, you should get the same 85 that you use at the recoverable amount. Okay. So after the impairment, you now show the new value of the asset. That is what we normally do. After the impairment, you show the new value. But this one, since I'm using the same sheet, that's why I do it like this. After the sharing of the impairment, you have to show it individually like this. So you say carrying value after impairment. Then you pick your value at the beginning, you subtract your impairment losses from it to put the new value there. All right. Basically, this is what about the cash generating unit. All right, let's look at reversal of impairments. Reversal of impairments. Sometimes what normally happens is that what is causing the impairment loss, the condition can no longer exist, like the government legislation. At the end of the day, the government has taken that legislation that, okay, this particular software can now work. It means that the software will now be useful. The software will now be useful. So what we do is that if you want to reverse the impairment, it means that all things be equal. If the legislation was not there, there won't be any impairment. But the legislation has been passed, and now they are saying that the legislation is no more there. It means that we assume that the legislation was not in place at all, and the impairment has not occurred at all. If the impairment has not occurred at all, what should have happened? That is what we normally do. So let's look at reversal of impairment loss. Reversal of impairment loss. Okay. Reversal.
Another example.
All right. If the indicators, another example on what? The cash generating unit.
Oh, I'm okay.
Okay, I don't have time. I'm doing non-current asset head for sale today, so I have to speed up. All right. Reversal of impairments. If the indicators that led to an impairment is favorable resolved, then in certain circumstances, the impairment is reversed. A reversal of an impairment loss reflects an increase in the estimated service potential of an asset or group of assets. The increased service potential may be through sale or use. Any reversal of impairment loss for an asset other than goodwill should only be recognized to the extent that it increases the carrying value of the asset to its original pre-impaired value less subsequent depreciation. So they are saying that reversal of any impairment loss other than goodwill, it means that we don't reverse what? Impairment for goodwill. We don't reverse impairment for goodwill. This is because we assume that the goodwill is as a result of maybe increase in the activities of the company, which cannot be separated from the goodwill. So we assume that the goodwill arising is internal generated goodwill, not goodwill through acquisition. So we don't do reversal for goodwill. The reversal of impairment loss is recognized in profit or loss unless it is on revalued asset, where it is treated in OCI. All right. An impairment loss recognized in respect of goodwill should not be subsequently be reversed. This is because it is likely that any increase in the recoverable amount of goodwill in future will arise as a result of increase in internal generated goodwill rather than reversal of an impairment. So that is why we don't. The assumption is that the goodwill that you are talking about might be the knowledge your staff is having, your relationship with your customers, which you don't have control over. So we don't reverse impairments. But if there is an reversal of impairment, what we do is that we assume that the impairment has not occurred at all. The impairment has not occurred at all. If the impairment has not occurred at all, what should have been the carrying value of the asset up to today? Then we look for the carrying value. Then we compare with the new carrying value. Then we add the amount that we're supposed to add. Let's pick example, then we know what we are doing. All right. What is that example? There is an example on that. Oh, where are you? Where are you? Where are you? Have you have you been trying the questions at all? Because no one called me on questions on standards before. Is it that you don't have any problem or what? Or the course will come?
The whole
It's
show.
okay.
Okay. I'm looking forward to that. What is that question? What is this question? Is it the last question or the last two? Okay, let's look at question 17. Okay. Who is reading? Kevia.
I'm here.
Okay, read for us.
Question 17.
Okay.
Boxer purchased a non-current asset on 1st January 2001 at a cost of $30,000. At that date, the asset had an estimated useful life of 10 years. Boxer does not revalue this type of asset, but accounts for it on the basis of depreciated historical cost.
Okay.
At 31st December 2002, the asset was subject to an impairment review and had a recoverable amount of $16,000.
Okay.
At 31st December 2005, the circumstances which caused the original impairment to be recognized have reversed and are no longer applicable, with the result that recoverable amount is now $40,000 required. Explain with the supported computations the impact on the financial statement of the two impairment reviews.
Okay. So when was the asset acquired?
First January 2001.
When are we doing the impairments?
31st December 2005.
2005.
How many years after?
5
5
years.
years.
5 years.
Are you sure?
January
5
2.
years.
1, 2.
5 years.
5
5
years.
years.
5 years.
Are you sure? The impairment, the time that we are doing the impairment test.
December 2020. 31st December
2002.
Yes, that was when at December
2
30,
years.
the asset was subject to
Okay.
impairment review.
That's 20x. Yeah.
That is how
Yes.
many years?
2 years.
2
Okay.
years.
Yeah.
So for us to know whether there is an impairment, we need carrying value and recoverable amount, isn't it?
Yes.
The question has given us recoverable amount. So what do we need? We need the value of the asset at the day that we are doing the impairment test. So we have to now come and calculate for our carrying value. How do we do that? How do we do that? The value of the asset is what? So that would be
30,000.
1,000.
question 17. That is question 17, right?
Yes.
Okay, question 17.
Mm.
So the carrying value will now be carrying value will now be carrying value will now be, maybe you can do it. So we use the asset for how many years?
2 years.
2 years.
years.
So the remaining useful life will be 8 years, isn't it?
Yes.
So you can use 8 multiplied by, it's everything that you learn. From me there, you learn everything here. Okay. So 10 over 10,000 divided by 10. That is your carrying value.
Mm.
Another way of doing it is that you find your depreciation for 2 years and subtract it from the 10,000. How much are you getting here? I'm getting
I have
And now is it 10,000?
24,000.
Is it 10,000? It's not 10,000.
30,000.
It's
30,000.
30,000. Okay, sorry. 30,000. So how much are you getting?
I had
24.
24,000.
Okay, 24,000. That is our carrying value. But what was our recoverable amount?
16,000.
Recoverable amount is what?
16,000.
16,000. So the asset has impaired by how much?
8,000.
8,000.
So our impairment loss is now calculated as
8,000.
is now calculated as the 24,000 minus what? The 16,000. Are we okay there?
Yes.
So our impairment loss. Our impairment loss will now be equal to 8,000, isn't it? Okay.
Mm-hmm.
So in the statement of profit or loss for 2S2, what we are going to do is that we are going to recognize the depreciation of what? 3,000
6,000.
and also impairment of 8,000, isn't it? All right.
Mm.
From 2, someone is texting. Why is the impairment loss
The other question.
85 instead of 90? The impairment loss was not 85. Oh. The impairment loss was not 70.
Yes.
The impairment loss was 70, which is the carrying value of the cash generating unit minus the recoverable amount, which is 70. So after we shared it, this is how we shared it. So the 85 that you are seeing over here is after we have taken the impairment loss from the original value of the asset. That's how we have the 85 here. So what will happen is that you just listen to the recordings. If you have any problem, then you hit me up. Can we move on? Okay. So from 2S3, what will be the value of the asset now?
24.
24,000. What will be the remaining useful life?
8 years.
8 years. Okay. Remaining useful life is 8 years. Okay. When was the review done?
December.
When was the
31st
review done?
December. 20x2.
The review
Okay.
at
2005.
31
20x5. 20x5.
How many years after the impairment?
3 years.
3 years.
3 years. So we need to find our carrying value as at the day that they are telling us that the recoverable amounts has. We need to find the value as at that date. So for us to find that, it will be the same as, no, the value will not be 24,000, it will be 16,000, which is the new recoverable amount. All right. After the impairments, the recoverable amount becomes the new value of the asset. Kati, are you there? So
Yes,
the value of the
please.
asset will not be 24,000. That was the original value, but that value has reduced by 8,000. So the new value is now
So the number of years will still remain 8 years.
Yeah, they didn't say anything about that. So we have 16,000 divided by what?
8.
Divided by 8. And if you like, we multiply the answer by what? 5, because we have used the asset for 3 years. So the remaining 5 years will be that one. So if you do it, so I'm looking for the carrying value, then I'll multiply my answer by 5.
It will be 10,000.
So that will be 10,000, isn't it?
Yeah.
Mhm.
Okay. So my carrying value will now be 10,000. My carrying value will now be 10,000. But what value are they saying right now? That is the recoverable amount.
40.
40,000.
40,000. Don't go and say you are going to take 30,000 to what? As a gain. No. The impairment that you recognize was only 8,000. So you can't reverse impairment more than the 8,000. Okay. So the recoverable amount now is, let's look at this. The recoverable amount now is what? Is
40,000.
40,000. Okay. So if at the date of the reversal, what you do is that you ask yourself that, because the condition is no more there, you just assume that the impairment has not occurred at all. If the impairment has not occurred at all, what should have been the carry value of the asset as at the day that you are doing the reversal? So
10,000.
if there was no impairment loss at all, it means that we will still be depreciating the asset using the 30,000, isn't it?
Yeah.
We still be depreciating the asset using 30,000 over 10 years. Am I correct?
Yeah.
Okay. After how many years that we are doing the reversal? It's after 5 years, isn't it?
5 years.
So we multiply this by 5. So what will be the carrying value now?
15,000.
15,000. Okay. 15,000. That will be the carrying value. But what is the carrying value? What is the carrying value after we have done the impairment? What was the carrying value?
10,000.
10,000. So what is happening? What do we have to do to make it 15,000?
We have to reverse it.
We have to do what?
Top up.
We have to add what? We have to add 5,000 back.
Mm.
Okay. So this 5,000 that we are adding back is the one that we are going to take to the profit or loss as the reversal of impairment. So the reversal of impairment will be only the difference between the original carrying value and the new carrying value after the impairment. At the date of the reversal, what is the carrying value after the impairment? Compare with if the impairment has not occurred at all, what should have been the carrying value? The carrying value should have been 15,000. So we have 10,000 plus 5,000. It is this 5,000 that we send to profit or loss
Right, the first one.
as reversal. So we send the 5,000 as reversal to this one. Do you know why we are not the actual reversal that we should send was supposed to be 8,000, isn't it?
Yes.
That was the impairment. Okay. But originally, how like what was the annual depreciation for the asset before the impairment?
3,000.
3,000, isn't it? Okay.
Yes.
After the impairment, what is now the depreciation for the asset?
2,000.
2,000. But we have used the asset for how many years before doing the reversal?
3 years.
3 years. It means that the depreciation, which should have been what? 3,000, 3,000 is now 2,000, 2,000. So for that 3 years, we have reduced the depreciation by 1,000, 1,000, 1,000, making 3,000. Are you okay?
Yes.
So since you have now doing the reversal, meaning that the impairment has not occurred, it means that those depreciation that you have reduction over them, which is 1,000, 1,000 for 3 years, must also be recognized as well. If those are recognized as well, it means that the impairment loss will no longer be 8,000. The reversal will be 8,000. The reversal will be the depreciation that you undercharge as a result of the impairment loss minus the total impairment loss. That's why we are doing the reversal for only 5,000. The remaining 3,000 is covering the undercharge depreciation for 1,000 for the 3 years that we didn't take there. But since we are assuming that there was no impairment, it means that those 1,000 depreciation should have also been recognized for the 3 years. So we subtract it from the reversal amount, then we send the difference to profit or loss as the reversal. That is how we do about the reversal of impairments. Ladies and gentlemen, any question? If you don't have any question, I'm moving to non-current.
So, Linus,
Yeah.
the 5,000,
Yeah.
is it going to be an expense or an income?
No, you are reversing impairment loss. Impairment loss was first an expense. So if you are
An
reversing it,
expense.
it will be income. Are you okay?
All right, this one there.
Linus,
Yeah.
please, I'm lost. So with the current value, at least can you put some headings on top, like current value if impairment,
Okay,
if there were
okay.
no impairment, so that at least we can differentiate
Okay.
the current values you have.
Okay. So this carrying value, let me put the first one here. Or let me just add a date to it. So this will be 2S2, isn't it? 2S2. That is the beginning of the 2S2. The next, this it's not a paper part. Okay. So the first one is the first carrying value. Let's move on to the next one. The next one is the 2x5. Let me put a 2x5 here. At the end of 2s5. 2s5 December. Let me put 2s5 December here. Okay. Carrying value. Carrying value if there was no impairment. Carrying value if there wasn't impairment. Okay. All right. Okay. Are we okay now? All right.
I don't know.
Okay. So
Yes, I don't know.
if there's no question on impairment loss, I want to start on current asset held for sale and discontinued operation. All right. If they talk about non-current asset held for sale and discontinued operation, it means that firstly we are buying, we have printing machine that we have been using for our day-to-day business activities, but we have realized that no, we have acquired a new printing machine, so we don't need the old one again. Then we put up the old one for sale. We put up the old one for sale. It means that we are changing the asset from day-to-day activities to now to we want to sell it. So if you are putting the asset up for sale, that is what we call asset or non-current asset held for sale. It means that you are first using the asset for your day-to-day activity. You don't know, like right now, you don't need it again. You no longer need it. So what you are going to do is that you want to sell it. So you put for sale on it. That is why some people will put for sale on the car because they want to sell it. So if you are putting for sale on it, it means that you are classifying that particular PPE as held for sale. That is basically about the held for sale. The held for sale, what means is that as soon as as soon as the entity classify the asset as held for sale, they will stop using it because you want to sell it. How will you sell what you are using? Why will you sell what you are using? You put for sale on the car and you are still using the car. It doesn't make sense. So if the asset is being classified as held for sale, what happens is that the entity is no longer going to use the asset. Therefore, we don't calculate depreciation on asset held for sale. We don't calculate depreciation on asset held for sale. We don't calculate depreciation on asset held for sale. So before you classify asset held for sale, there are conditions that you must meet. The entity must meet before they will classify the asset held for sale. All right. The first one is the sale should be properable. The sale should be properable. If you say the sale should be properable, we are saying that the disposal should be within a year. The disposal should be within a year. The asset should be sold immediately. The next one is the asset should be in all conditions that will make it available for sale. You are carrying out a maintenance on the asset, and the maintenance will be done in 2 years' time, and you are saying that you are going to classify the asset as held for sale. No, it doesn't make sense. It doesn't make sense. The next one also is that the asset should be, okay, I've said that that is why I say the asset should be available for immediate sales, which is the asset will be in a good condition that you can sell it. Not that the asset is at mechanic shop, the car is at mechanic shop, and you are saying that you are classifying it as held for sale. Someone will come there, you say that the car is at the mechanic shop. No. The asset should be available for immediate sale. The company should also carry out activities to allocate a potential buyer. The company should also carry out activities to allocate a potential buyer. All right. Those are some of the things, but I will share some of the conditions with you. Some of the conditions with you. Non-current asset held for sale and discontinued operation. All right. I hope you can see non-current asset held for sale and discontinued operation. Can we see that? Can we see? Okay. So they say non-current asset held for sale. We are talking about those assets that the entity would get money from them, not through continual usage, but through only sale. That is why we say non-current held for sale and discontinued operation. You don't need the asset again, but you're not going to get money through continue using it, but you want to get some money from it by selling it. So if you are going to sell it and get money, then we say you can classify that particular asset as non-current asset held for sale. So the non-current asset held for sale and discontinued operation says that non-current asset or disposable group should be classified as held for sale if its carrying amount will be recovered primarily through a sale transaction rather than through continual use. So you can get amount from it through sale, not that you continue using it, not value in use. It's true net realizable value. Okay. We try to explain what we call disposable group. Disposable group. For impairment, we say that cash generating units. If you want to dispose of the cash generating unit, then we say that is a disposable group. It means that if you are selling the store, everything in the store will be sold together with the store. The bulb, the tables, everything in the store will be. You are selling the shop as a whole. So if you are selling a cash generating unit, we say that is a disposable group, or various items that is going to be sold through a single transaction. That is what we call disposable group. So the provision store over there will be classified as a disposable group. A group of assets to be disposed of by sale or otherwise together as a group in a single transaction, and liabilities directly associated with those assets that will be transferred in the transaction. So if you are going to sell the provision store at once, the person will pay at once and the person will have ownership over everything. The provision store will be classified as disposable group. What do we do? If you are classifying the asset at held for sale, what are the things that you have to do? All right. These are some of the conditions that you have to meet before classifying the asset at held for sale. In the exam, they can ask you, state 3 or 4 conditions that you have to meet before you classify the asset as held for sale. One of them is that the sales is highly probable. The sale should be within a year. What most of the accountants they do is that they want to make their profits look good. So what they will do that they will classify the asset held for sale because they're not going to charge depreciation on it. So instead of them charging the depreciation on the asset for that year and take it from their profits, they will classify the asset as held for sale, and that depreciation portion will not be subtracted from the profit. So the profit will be high. Then the next year they will release the asset that they are not going to classify for held for sale again. It means that they have made a depreciation, they have made a profit for that previous year higher, and they are going to charge double depreciation this year, which is for last year and this year, to reduce the profit. It's also one of the creative accounting techniques used by the accountant. So they say that the sale should be highly probable. It should be within 1 year. The item is available for immediate sale in its present condition. I've said that already. That you are saying that you are selling the asset, but we still need to do maintenance on the asset. You are saying that you are selling your car, and your car is at mechanic, it's at a shop. And you say you are selling. No, the asset is not ready for immediate sale. So the item should be in a condition for immediate sale. An active program to locate a buyer has been initiated. So you want to sell the assets. You have started going to radio to run adverts for the listing. So you are doing activities to locate a buyer. So you can classify the asset held for sale. Not that you say you want to sell the assets, you are not doing anything. You are just sitting there. The company is just sitting there. They are not even running advert or throwing flyers to get people to come and buy the assets. So there should be an active program to locate a buyer for the asset. The sale is expected to be completed within a year from the date of classification. So if you are okay with that, that is okay. Management is committed to a plan to sell them. So not that you classify the assets 6 months time, then you say that no, our decision has been taken and we want to sell it. We are not going back. All right. The item is being actively marketed at a reasonable price in relation to its current value. You are selling Benz which you bought 10 years ago. Now you want to sell it for 1 billion. It doesn't make sense. The price that you should put on the asset should reflect the current market price of the assets. That's what they are saying. Okay, so these are some of the conditions that they can ask you in the exam as conditions that have to be met before you classify the asset as held for sale. Measurement of asset and disposable groups held for sale. Before you classify the asset as held for sale, what value should you place on it? The items classified as held for sale should, according to IFRS 5, be measured at the lower of their carrying amount and fair value less cost to sell. This is one of the reasons why I'm treating this and impairment together. They have everything in common. So if at the dates, Francis, put your video off. I wanted to take your video off there. All right. Okay. So what is happening is that, okay, what they are saying is, let me share something with you. Basically, what they are saying is that at the date of classification, find your carrying value. Assuming the carrying value is 5,000, net realizable value is 4,000. Okay, your carrying value is 5,000. They are saying that the value that you can sell the asset is 4,000. If you want to classify the asset, what value are you going to give to the asset? Is it 5,000 or 4,000?
4,000.
4,000. Okay. That 4,000, then the difference, which is 1,000, what happens? The difference, which is 1,000, what happens?
You expense it.
The asset has impaired. That will be considered as impairment because the carrying value is higher than the net realizable value. But for non-current asset held for sale, we don't do value in use. We assume that the carrying amount will be recovered through only sale. So we only look for the net realizable value. So if the carrying value is higher than the net realizable value, it means that the asset has impaired. But if at the date of classification, you now have 6,000, what is happening? What value are you going to attach to the asset? 5 or 6?
5,000.
5,000. We assume that you are only going to recover only the carrying value. So you classify the asset at the lower of the carrying value or the net realizable value. If the carrying value is higher than the net realizable value, it means that the asset has impaired. If the carrying value is lower than the net realizable value, then we classify the asset at the carrying value. So at the date of classification, what you have to know is that what is my carrying value and what is my net realizable value. You can also do workings for the carrying value because they can't give you these two figures at the same date. It means that they are not asking you to do anything in the exam. So they will give you the cost of the assets, then they'll give you the date that they want to classify the assets. You have to do some calculation of the depreciation to know the carrying value as at that date. All right. Okay. Let's move on. Let's pick some question. Then we okay. Where fair value less cost to sell is lower than the carrying value, the item is written down and the written down is treated as impairment what? Loss. Where the carrying value is lower than the fair value less cost to sell, the asset is carried at the carrying value. No adjustment is made to the value. Okay. Let's come here. Let's come here. What we normally do is that, you see, it's not easy. The non-current asset head for. So we assume that we are only classifying assets that are carried under cost model. Most of the standards are relating to assets that are carried under cost model. Under cost model, impairment cost model. Non-current asset head for. So we assume that the asset is, we are classifying asset that is carried under cost model. That is carried under cost model. All right. What if the asset is carried under revaluation model? What is the asset is carried under revaluation model? Let's look at this example. Okay. Okay. Let's look at this example. Assuming the asset is carried under cost model. The asset is carried, okay, assuming the asset is carried under revaluation model. And the carrying value is 5,000. And now the fair value is what? 6,000. At what amount are we going to classify the assets?
5,000.
Why 5,000?
The fair value.
Someone is saying fair value, but someone is saying 5,000. Okay. This is revaluation model. What we normally do is that the asset will be classified at the 6,000. Then we recognize 1,000 as revaluation gain because the asset is classified under revaluation model. So at the date of every reporting or at the end of every reporting year, we value the assets to fair value, to fair value, to fair value, to fair value. So if the asset is carried under revaluation model, if the carrying value is higher than the net realizable value, then the asset will be carried under this one. So if this one is 4,000, it means that the new fair value is now 4,000. So we are going to have revaluation loss of 1,000. But if it is 6,000, the asset will be carried at 6,000. Then we have revaluation gain of 1,000. So a situation where you carry at lower, the assumption is that the asset is carried under cost model. The asset is carried under cost model. All right. If non-current asset is measured using a revaluation model, it means the criteria to be classified as held for sale. It should be revalued to fair value immediately before it is classified as held for sale. The person who said the 5,000, are you okay now? You revalue the asset before you classify it as held for sale. It is then again at the lower of, it is then revalued again at the lower of the carrying amount and the fair value less cost to sell. The difference is the selling cost, and this should be charged against profit in the period. So sometimes the company is paying for maybe cost to sell, then the cost to sell will reduce. Okay, the cost to sell will reduce don't worry, we pick questions, then we look at what they are doing. When the disposable group is written down to fair value less cost to sell, the impairment loss reduces the carrying amount in this one. So the impairment will also be, if we are disposing disposable group and there's impairment loss, the impairment loss will be shared in the manner that we share it for the IS-36. Physically damaged asset will take it first. Goodwill will take it, then we prorata the rest. Asset held for sale is not depreciated, even if it is still being used by the entity. So basically what we do is that if the asset is held for sale, the entity is not going to use it. So the entity is not going to use it, and the entity is not going to use it to generate any cash flow again. So since the asset is not generating any cash flow, we can't match the expenses against the revenue because the asset is not generating revenue to the company. So when the asset is classified as held for sale, it is not depreciated. When the asset or disposable group is actually sold, a gain or loss is ascertained on the disposal and treated to the income statement. So we have classified the asset at 5,000. Now we sold it for 6,000. We sold the asset. We are having a profit of 1,000. That is what they are saying. All right, let's come here. Let's take a question. Example 1. Example 1. Example 1.
I know someone is asking you a question in the chat box.
No, maybe that question was old one. I can see thanks. Yes, it's clear. So maybe you, because you have been off for some number of years, that is why that is showing at your end.
No, it's not. Oh, the person is asking whether there is no impairment gain.
Debbie, I can't see over here.
Your light was out again.
The person should ask again. What is the person's name? What I can read over here, my network went off.
Socrates is asking you that question.
But I can't read.
Impairment gain is when we do reverse. Okay, Socrates was answering the question.
Okay. So he has. I've seen this. This thing was long time ago. This thing was long time ago. Impairments loss. It is swipe but no land. After that one, then that message. And someone say, Joy say thanks. Joy also say it's clear. That's what I can read. The one that you are talking about was something long time ago. Maybe last year. Okay. Let's look at the first example. Okay, let's look at this one. This one is not, it's just a theory. Let's read it and answer it. On December 1, 2003, a company became committed to a plan to sell a manufacturing facility and has already found a potential buyer. The company does not intend to discontinue the operations currently carried out in the facility. At 31, 2003, there is a backlog of uncompleted customer orders. The subsidiary will not be able to transfer the facility to the buyer until after it ceases to operate the facility and has eliminated a backlog of uncompleted customer orders. This is not expected to occur until spring 2X4. Required. Can the manufacturing facility be classified as held for sale at 31 December 2X3? Can it be classified as held for sale?
Yes.
No.
Okay.
No, it cannot be classified.
Committed to a plan.
This is because it did not meet the criteria for held for sale asset.
Okay.
The asset should not be in use.
Okay. Though the answer is no. It cannot be classified as held for sale. You can write no there and say, well, that is the answer. No explanation is no. But you have to say why it's no. Although the company is committed to the plan to sell the assets, that is, they have met one of the
criteria,
and they have also found a potential buyer. But the question is, can the asset be transferred to the potential buyer now? Is the asset in a condition that can be transferred to the potential buyer? And you can say the company, they are not willing to discontinue the operation. It means that they are not willing to sell.
Okay.
And the question is that they also have a backlog of customers' orders. they have to complete the customer's orders. If this will be done in 2 years' time, it means that a potential buyer will be waiting till 2 years' time. And they say that the asset must be available for immediate sale. The sales must be within what?
1 year.
1 year. The question also says that
Within a
the
year.
subsidiary will not be able to transfer the facility to the buyer until after it ceases to operate the facility. So if they continue operating the facility for 5 years, are they going to? They say non-current asset held for sale should not be used. It should just be there. Classify it. You are still using the thing, and you are not willing to transfer it. If you are going to complete your operations, or you are going to cease your operations in 5 years' time, it means that the asset will be transferred at 5 years' time, which is going according to one of the conditions. So although
Linus,
they have a potential buyer, yeah.
so meaning all the conditions must be met.
Not all the conditions must be what?
Met.
No, the conditions, all of them must be at least. You should not you should not meet some and violating some. No.
Okay.
If you are meeting some, it means that you are not going contrary to any of them.
Others. Okay.
Okay. But this one, they plan, you see, the plan to sell over there is a minor one. It's a minor condition because the people are not willing to sell. If they are not willing to sell, how will you plan to sell?
Okay. Okay.
So you can see that the no is what is overpowering the yes. You plan to sell. How do you plan to sell? If you plan to sell, it means that you should be willing to transfer the asset to the buyer.
Yes. Okay.
But you're not willing to transfer. It means that you are just deceiving us. It's just like Ghana. We are deceiving that we are serious, but we are never serious. So this situation is just like Ghana. So the assets cannot be classified as held for sale. All right. Let's pick a question on held for sale. We solve it, then we move on to subsequent measurements.
Did you check our match? I mean, match. I think there was a question like that.
Yes, it is part of this one. We solved that one too. Oh, you see, I don't want to be solving the questions. I don't want people to be like remembering the day that you were sweating there. You see that thing?
It is normal. It is normal. I see those things, they are normal. So why should go?
It is what it is. The rain is coming again.
Linus. Oh. It is normal. It's not JSS or university or master's exams that you are writing on. This is ICA. So after failure there, it's part of it.
The rain is coming again, Charlie.
Rain, we beg.
Let me find a place and put my machine, then we continue.
Okay.
Let's forget the rain and continue. Let's solve question 2. Who is reading the question 2 for us? Who is reading the question 2 for us?
At 1st April 2024. Sorry. At 1st April 20x4, Tilly owned a property with a carrying amount of 800,000, which had a remaining estimated life of 16 years and was carried under the cost model. On 1st October 20x4, Tilly decided to sell the property and correctly classified it as being held for sale. A property agent reported that the property's fair value less cost to sell at 1st October 20x4 was expected to be 790,500.
Okay.
Which had not changed at 31st March 20x5.
Okay.
Required. Should I read that one?
Yeah, read.
In accordance with IFRS 5, non-current asset held for sale and discontinued operations, demonstrate the accounting treatment of the above information in the financial statement of Tilly for the year ended 31st March 20x5.
Okay. So they have given us a carrying value at April 1, 2x4, isn't it? When when did the entity decide to sell the assets? At what date?
On 1st October.
So how many
1st
months or
October.
how many years after?
Is it years? Months.
Years or months after?
6 months.
6 months. So if you want to know the carrying value as at the date of October, what do we do?
We depreciate.
We depreciate for 6 months and take it from the value that we have at the beginning, isn't it?
Sure.
All right.
Okay.
So we need carrying value and the value, the net realizable value. So let's find October. October.
That's what.
October 1 or 30. It's October 1. April, May, June, July, August, September. Okay, that is 6 months. Where is that? All right. So let's come here. So let's find our carrying value at October 1, not 30. This one. 01. So October 1. What is the carrying value now? The carrying value will be the amounts at the beginning. What is the amount at the beginning?
800,000.
800,000 minus the 6 month depreciation. Am I correct?
Yeah.
Okay.
Depreciation should be for 5 months.
Is it 5 months?
First, yes. First
No.
April
October, April is 1
It
month.
doesn't include October.
But April is 1 month. Count it. Sometimes you
Yes,
know,
April, May, June, July, August, September.
if you are not
So,
sure, use your
6 months. Okay, it's 6 months. Okay.
because I use my hand.
Yes.
Sometimes if you are not sure, use your hand. Nobody,
That's the best.
the invigilator will look at you and you will not say anything.
Use your fingers.
That's all.
So that will give us
25,000.
so let me put the depreciation. It will be 80,000 divided by how many years?
16
800,000 divided by 16
times 6 months.
times 0.5. Am I correct?
Yes.
Okay. Times 0.5. Okay. So the carrying value will now be how much?
775,000.
77 carrying value.
Somebody should confirm, I beg.
Kati, confirm for us.
I'm checking. Which one should I confirm? Is it the current amount?
Confirm.
Confirm the carrying amount.
775,000.
Confirm.
Confirmed.
77.
5000.
Okay. Okay. The confirms are too much. So this will be 25,000, right? The depreciation.
Yes, please.
Yes.
Carrying value of 775,000. All right. What is the net realizable value given to us?
790,500.
780.
90,500.
Okay. So what is happening? Is the carrying value higher than the net realizable value?
Yes.
No.
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 The net realizable value is higher.
It's higher. So what amount are we classifying the asset?
The carrying amount.
The assumption is that we assume that this asset is being carried at cost model. Are you okay?
Okay.
Okay. So if the asset is carried at a cost model, it means that it will be cost minus accumulated depreciation. All right.
Yes.
So the asset will be carried at the lower of any of the two. So the asset will be classified as the carrying value. But if the net realizable value is lower, it means that there is an impairment of the difference. Okay. So the
And
asset,
then we carry it at the net realizable value.
exactly. But if the asset should be carried under revaluation model, then we send it to the 790 and recognize revaluation gain before we classify the asset. Are you okay? All right.
Please come again.
I'm saying that if the asset is carried under revaluation model,
Okay.
then at the date of the classification, we assume that we revalue the asset to 790,500. Then we recognize the revaluation gain
Okay.
before we classify the asset now. But all that we know is, all that we were all taught is, we assume that the assets are being carried under. They will not even tell whether under cost model or revaluation model.
Okay.
All right. It is what it is.
But this one, they said this under the cost model.
Okay.
The question said under the cost model.
Exactly. Okay. So that is
So
what.
under the revaluation model, after realizing the gain,
Yeah.
you keep the assets as what? At the fair value.
At the highest one. You assume that at the date you revalue the asset before you are classifying it. So you revalue before you classify.
Okay.
All right. So if you revalue before classifying, it means that the net realizable value is the same as the carrying value. Because if you revalue, the 790,500 will now be the new carrying value, and which is the same as the net realizable value. So they are all the same. You just pick.
So what if you revalued it and it is lower? And
if the net realizable value is, let's assume that it's 776,000 or 745,000. Okay. So if you revalue, it means that we are going to have a revaluation loss. Are you okay?
Yes.
Which is the same as impairment for asset carry under cost model. For revaluation, for asset carry under revaluation model, their impairment is called revaluation loss. But assets that are carried under cost model, their impairments are called impairments. Okay, let's move on. That is the first one. Let's look at whether we can solve additional questions. Then we look at let's look at, okay.
As a line, I'll solve the match question.
Okay, sorry. I'll solve the match question for you. If we can finish this topic today, I'll be very happy, pa.
You see, sometimes they bring a lot of dates, plenty. That is what confuses me.
That is what confuses you. Okay, question 10.
Yeah.
Nkunya is a local fruit processing company whose accounting year is December 2021 and prepares its financial statement using what?
You are laughing.
I'm not laughing. I'm just smiling.
Yeah.
Using international financial reporting standards. Okay. On April 2021, Nkunya moved to a new head office and decided to sell its old premises. So the day that they are going to do the reclassification, or the day that they are going to do the classification, will be April 1, isn't it? Take note of that. On April 1, Nkunya moved to a new head office and decided to sell its old premises. It means that they are going to classify the premises as held for sale on April 1, 2021. Okay.
Yeah.
Agents were appointed to assist with the sale. As at January 1, 2021, the old premises had a carrying value of 8.4 million. When are we selling the assets? When are we deciding to sell the assets? April 1, isn't it? April 1. But they are giving you the carrying value at the beginning. It means that we have used the asset for 3 months before we decide to what?
Yes.
Classify. Okay. The old premises had cost 10 million and were being depreciated over their expected useful life of 15 years. Okay. Okay, that is very nice. The agent advised the director that the market value of the old premises at April 1, 2021 was 7 million and a commission of 1% was payable on sale. So the 1% will be paid on what? 7 million. They are going to charge a contribution, they are going to charge a commission on the selling price, which is a 7 million. We charge contribution on the selling price. As a contribution, right? We charge commission on the selling price. So the 1% will be agent fee, which will be on the 7 million. Okay, no entries have yet been made in respect of the old premises for the year ended 31 December, but the sale was finalized on January 2x14 net proceeds of 6.8 million. Show how the property should be due with in the financial statement of Nkunya for the year ended 31 December 2021. All right. You can see that the asset was sold after the reporting date, isn't it? All right. What we normally do is that we only take into consideration the after reporting date figure if the asset was sold below their carrying value. Then we say that, okay, we are making a loss. Then we can adjust the loss. All right. But don't worry. Let's pick the question.
If it's profit, what happens?
We don't recognize it. The profit will be recognized in the subsequent year, which is this is supposed to be 2022.
Yes.
This is supposed to be 2022. Okay. But the sale was finalized on January 2022. Yeah.
I was confused.
Okay.
Are you the one who typed it wrongly? I have the original question.
Yeah, I'm the one who typed the question wrongly. I used to type them myself. And Charlie, it's not easy. All right.
Yes.
So on April 2021, Nkunya moved. So they decided to sell the asset on April 2021. Are you okay? Okay. As of January 2021, the old premises had a carrying value of 8.4 million. The old premises had cost 18 million and were depreciated over their estimated useful life of 50 years. Do you know why they have given you this one too again?
Which one too?
Do you know why they have given you the cost and then the total useful life?
To help you get the depreciation for the year.
Exactly. If they didn't give you this particular one, then they will give you the remaining useful life in relation to the carrying amount.
Yeah.
Okay. So first thing is, let's find the carrying value of the assets. Let's find the carrying value of the assets. As at the date of the classification, which is April 1, 2021. So question 10. So let me come here. April 1, 2021. So let's come to the carrying value. Okay. I will show you another way of calculating this carrying value. The carrying value will be 8.4. 8.4 minus into brackets 10 over.
The carrying value on which date? On April
1.
1st January.
No, on April 1, 2021. We are looking for the carrying value as at that date, which will be 10 over 50. Then all of this multiplied by 3 over 12.
Yeah.
So you find the depreciation for only the 3 months. Then you subtract it from the carrying value at the beginning of the year.
It was, I think, 7.9 or something. Yeah.
All right. So the depreciation at the beginning of the year, the carrying value was 8.4. So what portion of this was used? Then we use the original value to find the depreciation for the 3 months. Then we take it from the 8.4. All right. Let me also show you another way of doing that. You can also calculate the annual depreciation. What is the annual depreciation?
200.
If you do it, 0.2. 10 over 50 is what? Is
200,000.
200.
which is 0.2, isn't it?
Yes.
All right. So let's look at this one. What was accumulated depreciation up to January 1, 2021? It will be 10 minus 8.4.
100.
It will be 10 minus 8.4, isn't it?
Which one is that? Is it the accumulated depreciation?
As at January 1, 2021, it will be the total cost minus the carrying amount as at that date.
Okay.
Are you okay?
That's 10 million minus 8.4.
Exactly. What are you getting?
1.6.
16.
Getting 1.6. So this 1.6, it means that it is the annual depreciation of 0.2 that has been compared to get the 1.6, isn't it?
Yeah.
So for us to know the number of years, we divided by this
It's
one,
8
0.2.
years.
So that means they have used the asset for 8 years before what? Before trying to classify it. So another way of doing this is that if they have used 8 years already, it means that they are left with what? 42 years.
2 years.
So you can use the 8.4 and depreciate over 42 and multiply your answer by 3/12. Then you subtract it, you get the same
Hey,
answer.
Linus, the way you are saying plenty things, you do it one after the other for us
All
to
right.
get it.
Let's find the first one. Okay, the first one, what is the carrying value here? What is the carrying value after doing this? 10 over 50.
I think you get 50 or something.
10 over
It
50
will be
times 3
7.
over 12. I'm getting the depreciation to be 0.05.
That's 50,000.
Okay. Then if I take it from 8.4, what am I getting?
7.9.
8.35.
So let me do it 8.4 minus 0.05. Am I correct?
Yes.
Okay.
Linus, we are finding the depreciation for the 3 months.
Yes, I have gotten the depreciation for the 3 months already.
So that is the asset for, wait, so that is the current value for the January. Is that what you are saying?
The carrying value for January was 8.4.
Yes.
And we are doing the classification on what? April. It means that we have
April.
used the asset for 3 months. So we
3
can do the
months.
depreciation for the 3 months and take it from the carrying value at the beginning of the year.
So Linus, every year the depreciation is 200.
Yes.
Okay, so the quarter is not 50.
50 is 0.05. I'm doing it in millions.
Okay.
So I'm getting 8.35 million. Am I correct?
Yes.
Okay. I'm also saying that instead of you using this approach, you can also do it like this. You find your accumulated depreciation at January, accumulated depreciation at January, that one, which will be the cost minus the what? The carrying value at the beginning of 2021. What will be your accumulated depreciation?
1.6.
1.6, right? Okay.
Mm-hmm.
The question now is, what was our annual depreciation? What was our annual depreciation? It should have been, annual depreciation should have been 10 over 50. Am I correct?
Yes.
Okay. And that will give us how much?
200.
That will give us 0.2. Am I correct?
Yes.
Okay. So this 1.6 over here, it was 0.2 that was accumulated for a number of years before we have gotten the 1.6. So we multiply the 0.2 by a certain number of years before we get a 1.6. So what is that number of years? We just divide the 1.6 by 0.2 and we get 8 years. It means that the asset has been used for 8 years. So if the asset has been used for 8 years, then we cannot calculate our carrying amount simply like this by having the carrying amount or the carrying value equal to the 8.4 minus into brackets 8.4 divided by 42 years. That is the 8.4 is for remaining 42 years. Then all of these times 3/4. What am I getting? 3/12 rather. 3
90
over
things
12.
like
What am I getting? At the end of the day, we should be getting the same answer. Are we getting the same 8.35?
To be 0.
No.
It will be
8.4 over
8.4.
42 is 0.2 times 3/12. You should be getting the same figure at the end. Are you okay?
Yeah, 0.05.
Okay, then we subtract it from the 8.4, you get your carrying value as at that date. So this is our carrying value. Let's look at our net realizable value. So any one that you like, you use it. Okay. Net realizable value. Our net realizable value is the fair value. Is the fair value less cost to sell, isn't it? The cost to sell over here is the commission. Any cost that you are going to incur. Joyce, go for the first one. Go for the one that you are comfortable with. Yeah, go with that one. Okay. The net realizable value is the fair value
After that,
less cost to sell.
Let's do the Kuma, the Accra Academy way. Why? I beg.
Okay. The cost to sell is any cost that you are going to incur to sell the asset. It can be transportation, agent fee, and any of them. From the question, what is our cost to sell? From the question, what is our fair value? 7 million.
1%.
7 million.
Okay. 7 million.
Less than 1%.
Okay, 7 million. And our cost to sell is what?
1%.
0.07.
Okay. So we have our this one to be 7 million. Then we subtract our cost to sell, which is 1% on that. And that will give us 1.01 times the 7. Am I correct?
Yes.
Okay. That will give us how much?
0.07.
Okay. So if we subtract from that one, what are we getting as the net realizable value?
6.93.
6.9.
3.
Another way of calculating the net realizable value, someone should tell me. Charlie, you need to be creative in the exam hall.
Linus.
Yes.
I bet we don't have time in the exam hall.
Net realizable value, please. Let me understand. I'm not getting to understand. I know that 1% is 7. So why are we having? Oh, okay.
You say I should let you understand, but you are saying okay.
I'm using the full value, and you are using the you are working in millions, so that's okay.
Okay. So that is the problem now. Okay. So that is nice. So the
You
net
want to
realizable
use
value
that formula?
can also be gotten as the amount that we should supposed to take is 7 million, but we are paying 1%. It means that we are only taking 99% of the amount that we should have taken. So you can find 99% of the 7 million, you are good to go. All right.
Yes.
Okay. So let's come. So this one we are classifying the asset head for sale. Carrying value is 8.35. Net realizable value is what? 6.93.
6.93.
At what price are we going to classify the assets? At what amount?
6.93.
6.93.
6.93, yes.
So the difference over there will indicate what?
Impairment loss.
Impairment loss. So we have to calculate the impairment loss.
Have you seen your message?
If we learn so many things right now, we will mess up the simple procedure. This is the last question. This is the last question, so don't worry. But we have a lot to do. You see, the last time that I posted that thing, I hope that some people they were even discouraged. It's true. That is what you have to know. We have about 20 standards that we are not even yet to Charlie, it's not easy. But we'll get there, don't worry. Let's solve this one as the last question, then we call it a day. Okay.
What is the time?
It is 8:03.
You can continue to 9.
Are we going to have CR class?
Yeah, we have
separate?
CR. We have CR. So
Okay.
let me solve this one as the last question. So the next one, I'll move on to disposable group. All right.
Asset health and safety.
The difference is what?
Okay.
6.9.
Linus, who is this one?
Is that?
Which
FR.
one is this one?
This is FRO, senior.
Oh, really?
Yeah.
Combine.
It's a combined class.
The question you were solving was CR question.
I mean the
We are
standards is the same for all the three. The standard that
Okay.
FR people are doing the same standard CR will also do.
Oh, okay.
So what is the
Okay.
difference?
1.42.
Okay. So 1.42 million. That's supposed to be the figure, isn't it?
the
Yeah.
loss.
So for the statement of profit or loss, we are going to show impairment of what?
1.42.
And also depreciation of what?
50. Yes.
0.05.
0.05.
And 0.5, yes.
Okay. So in the statement of profit or loss, we show the impairment loss, and we also show the depreciation for the 3 months, which is 0.05. Okay. The asset was
Okay,
sold.
line.
Yeah.
That's okay.
Okay. The asset was sold at how much?
6.8.
6.8, isn't it? All right.
Yes.
We call something event after reporting date and event. We call something event after reporting date, which is the IS10. We have two types of events. We have no adjusting events and adjusting events. We talk about adjusting events, we are talking about those conditions that are existing before the reporting date. So we have if you talk about adjusting events, we are talking about those conditions that are existing before the reporting date. So if you have inventory, the inventory was there before the reporting date ends. So if there's a reduction in the inventory, it means that the reduction after the reporting date can be what? Adjusted. It means that the inventory was there before. But if you have issues about fire outbreak at the warehouse, was there any issue like fire outbreak from the beginning of the year to the end? No. So the fire outbreak is a non-adjusting event. But this one, you can see that the asset was classified during the year, so the classification was there. The classification
This is
was
why
there.
I got confused there.
It was there before the reporting day ends. But if you talk about non-adjusting event, we are talking about those conditions that are arising after the reporting day. But if you talk about adjusting event, those conditions that are existing before the reporting date. So in this case, the sale, if we have profit on it, we assume that, okay, that profit should be recognized in the subsequent year, which is supposed to be 2022. But what's happening? You can see that we are selling below what? The value that we should sell.
Carrying amount.
So we assume that the asset has been remeasured again and there was impairment again. Okay. So we still recognize the impairment loss before we initially sell the asset in the subsequent year.
So the impairment loss,
Yeah.
that one we can adjust it, so it will come into the year 2021. Am I right?
Yes, it will come. Impairment on asset is adjusting event because the asset is existing.
Okay.
The asset is in existence. So what we do over here is that we still calculate impairment loss using 6.93 minus what? 6.8. So we assume that the asset has been remeasured again. The asset has been remeasured again. For the non-current asset held for sale, the asset can be remeasured again, then there will be impairment loss. If the asset is being remeasured and there is a gain, we recognize the gain, but not more than the previous impairment gain, but we look at that later. So what is the difference from here? What is the difference from here?
0.13.
0.13.
So 0.13. So this will also be a subsequent, this will be impairment on a subsequent measurement. So the 1.42 was initial measurement, we have impairment, subsequent measurement will give us 0.13 as impairments. Are we okay? Basically, that is all.
Okay. Okay, Linus, please.
Yeah.
So because the asset was sold, was finalized in in the following year.
Yeah.
Okay, we will not state, will not bring the
We don't bring what? Kati, I want to hear you. I want to hear you. I cannot hear you. Kati, I cannot hear you.
asset.
Are you speaking in tongues?
I'm saying that we
Are you in the spirit? Kati, are you in the spirit?
Her network is bad.
That means she can change it to be in the spirit. You see, sometimes you're hungry, we do fasting.
Linus.
At the university, if you're hungry, we do fasting by force.
Linus.
Yes, I can hear you.
I'm saying that.
Yeah.
So because of the event after the report, we will not state the carrying amount under the
non-current assets.
Yes.
Yeah, the carrying amount that you are going to use will be 6.8.
Are you going to state it?
Yes, the asset will now be recognized as 6.8.
As asset held for sale.
Yes.
No more.
So
no
even
more.
though you have class, even though you have adjust your P and L with the impairment loss.
Kati, say the last part. I didn't hear the last part. You see the asset.
I'm saying that even though you have realized you have experienced the impairment loss of 0.13.
Yeah.
You still classify the asset again as asset held for sale in your financial statement.
Exactly. Because it's no more, the classification was done at April, which is no more up to 1 year. Which is no longer up to 1 year. The classification should last for at least 1 year.
Then why have you done the impairment loss?
The impairment loss will be 1.42 and 0.13. It's two impairments.
No, not that one. I mean the 0.13. That is what I don't get.
The 0.13, we assume that the asset has been remeasured. So if the asset has been remeasured, it means that at 31st December, the asset will be 6.8 before you sell it at 6.8 in the subsequent year. The asset was 6.93 at reporting, isn't it? Katia, are you there?
Okay.
Yes, please.
You are there. The asset was 6.93 at reporting. But what happens? We have reduced that value by 0.13. So what will be the new value now? It will be 6.8.
That one is a subsequent year. That is when you finalize the thing.
No, it is the subsequent year. But the assumption is that the asset has been revalued again at the reporting date because the asset was there before, after the reporting date. So there's an indication that the asset was there. So this is an adjusting event. Since we are going to adjust it, it means that the value must also be adjusted. If you are still carrying the asset at 6.93, it means that then you haven't recognized any impairment loss in the first place. So since you are recognizing the impairment loss, the effect of impairment loss on assets that the impairment loss is going to reduce the value of the assets. So we are going to
so you have to. Okay, so you have to use the proceeds that you get from the sale
as the value of the assets at the end of the year.
Financial position, okay.
Yes.
I'm okay.
So we assume that the asset has been remeasured before selling in the subsequent year.
Okay.
We are okay now.
I'm okay. Yeah, I'm okay.
So Linus.
Yeah.
Please, what if the asset was sold over, let's say the asset was sold for 7.2 million.
So if the asset was sold for 7.2 million, just leave it. You recognize your profits in the subsequent year.
Okay, so you use the 6.93.
Exactly. Then you
Okay.
sell, and then you have your profit on it.
Please, someone is having a question for you.
Yeah.
Look at it.
Someone is saying that I thought the asset is sold out. Why did we pay the commission? And the asset, when the asset is still with us, we are not paying the commission, but we are just assuming that the amount that we are going to pay, we are going to receive from the asset is 7 million, isn't it? But we are paying a commission of 1%. It means that we should have 7 million, but since we are paying commission, we net the commission against the process because we are incurring the commission because we want to sell. So the commission or the cost to sell is always adjusted against the 7 million. Whether we sell or not, these people, they will still charge the commission because we want to sell the asset. So we are committed to the sale. So the commission, no matter what happens, we will still pay the commission. We still pay the commission. All right.
You are always confusing as you this I see with your assumptions.
No, if you want to sell, I want to sell a cow. You say that if you want to get someone for me, you charge me this amount. Since I'm committed to the sale, it means I'm automatically going to pay you that amount, isn't it? So whenever you get a person, then I will take the commission that you are charging to you. So if I'm selling the car for 10 million, you say you are going to charge me 1 million. It means that at the end of the day, I'm getting only 9 million from it. The 9 million over there is the net realizable value now. The actual value minus the commission that I'm paying. I'm paying the commission because I want to sell. So the commission, which is the cost, should be charged against the proceeds that you are going to get. All right. That is it. If there is no further questions, ladies and gentlemen, my name is Brendela Venunye, but my friends call me Dela, and other friends also call me Brain. I'll see you same time on Saturday. I sign out for the first time. All right.
We're from the Linus.
The Linus, it's my father who gave it to me, but I don't understand.
And the Brain, you that one day you understand.
Yeah, I understand.